Hi everyone and welcome to this very exciting video. So we are going to review an ETF XIC, which is one of the broad Canadian market ETFs. So let's start with it. So what is XIC? XIC is an ETF. So the basic idea of ETF is investors provide money that goes to an ETF fund management company, and these ETF fund management company makes investment in different sectors and different stocks. So XIC invest in the broad Canadian market. So this is a way of you owning almost the entire Canadian stock market. So when you buy this ETF through your broker, through in your investment account, maybe tax-free savings account, RRSPs or anything like that, you own the entire stock market, like the Canadian stock market. The number of holding as of October 21st, 2022 is 236 companies or stocks. So what are benefits of investing in XIC, or a better question, why XIC? So I treat it as one of the foundational ETFs in your portfolio. Foundation means that most of your money, most of your like monthly DCA, dollar cost averaging, that you do into stocks, you could do it in this ETF. So personally, I have 35% of my portfolio in XIC because that's where I want to keep my Canadian stock exposure. So why XIC? Because you own the entire Canadian stock markets, almost like 90% plus market cap of the TSX stock exchange you own. It is very low cost and it is designed to be one of the long-term holdings in a portfolio. So these are the features, or these are the highlights of XIC ETF. So it is an iShare TSX Cap Composite Index ETF. So it invests in the broad stock market, Canadian stock market. The interesting part is the expense ratio. If you see, it's only 0.06%. So if you're putting, let's say, $100 into this ETF, then you are only paying like 60 cents every year in terms of expenses, in terms of management fee. Whenever you invest in an ETF or a mutual fund, you will have to pay management fees. Mutual fund management fees are very high. It is around 2 to 2.5%, but management fee in this ETF is very low. It is 0.06%. Right? So if you're putting $1,000 into this ETF, you're going to pay $6 as the fee every year for the management company, which is one of the lowest in the Canadian market. Now, interesting part, this ETF also pays you dividend yield of right now 3.19%. So when you invest in this ETF, you get exposure to growth in stocks, but along with that, every year you are going to get around 3.19% if you invest right now, right? That is the dividend that is expected from this ETF. So if you see sector wise investment that it does, so 30% of the money that you are putting into this ETF goes into financials, that is banking and financial services, because TSX is heavily weighted towards big banks like Royal Bank of Canada, TD, Scotiabank, etc. So allocations are more towards financials, followed by 20% in energy companies like oil and gas and other energy companies. Industrials are 13%, the mining sector is 13%, materials are 11.72%, tech is very low, it is 5.30%, so which is a flip-flop of the American market. So when you invest in the American market, let's say S&P 500, lot of your holdings, 20% plus of your holdings are into tech sector. So this is a good counterbalance to owning lot of American stocks and American ETFs. Communications are 4.82, utilities are 4.59, consumer staples are 4.13, real estate is 2.47. So it has most of the times all the sectors in the economy, but it is heavily weighted towards financial. So if you see value versus growth, this ETF is more towards the value side. You might not get the appreciation that Apple or Tesla you get in the American markets, but you get decent amount of dividends plus stability when you include this ETF in your portfolio. Top 10 holdings of this ETF right now is Royal Bank, TD, Enbridge, Canadian National Bank, Canadian Natural Resources, Bank of Montreal, Bank of Nova Scotia, Brookfield Asset Management, etc. So these are the stocks and their relative weightings, right? Top 10 weightings in this ETF. Now, if you see past performance of XIC, so since its inception, since it was incepted, it has given a total return of 6.47%. So that is your money on an average every year it grows by 6.47%, that is 6.5%. Last 10 years the returns have been 7.24%. So for last 10 years every year your money is on an average growing by 7.24%. Some years it will be higher, somewhere it will be lower, but on an average it is growing by 7.2%. So if you put it in numbers, if you invested $10,000, right, in let's say January 1st 2002, that is 20 years back, right now that $10,000 will be 39,061 in terms of price appreciation. Along with that you also get dividends. So this does not include dividend, it just shows you price appreciation of your $10,000. Now dividend yield on this ETF historically has been on an average 2.82%. Right now it is high because markets have gone down a lot. When markets go down, the dividend yield on ETF increases. So that's why when markets go down, it is a good time to buy dividend stocks, because for lesser amount of money, you get higher dividends, especially if you're looking for dividends. The maximum yield was 4.55%. The way it crashed in 2020, that's when the maximum yield was reached. But if you see last 10 years, right, the yield is quite decent right now. 3.11% dividend yield is quite high. The interesting part is every year on an average dividends have grown by 4% in this ETF. So if you see past 3 years average, and even if you go back further back, dividends keep on increasing after every few years. So dividend growth rate is 4.08%. It means on an average the dividends keep on growing. So if you project this dividend growth into the future, you can expect whatever dividend you're getting, it should double it up in 17.3 years. So forget about price appreciation. So if you put $1,000 into this ETF, right now you will get 3% yield. So somewhere around $30 of dividend. Okay. But if you continue investing, right, or if you keep that investment in place, 17.3 years later the dividend will go to $60 without you doing anything. So every year the dividend continues to grow. So this is the projected dividend. So 2024, right, growth rate as like this is 2024, so dividend are expected to be 0.931 per share. In 2032 it is expected to be 1.283 per share. Okay, so your dividend yield on your original cost will keep on going up over the years. So by the time you retire, right, let's say your retirement is 30 years away, you might expect like on that $1,000 somewhere around 6 to 7% dividend yield by the time you retire. Okay, if you stay invested. So what I've done, I've created an Excel sheet. So let me open that. So if you see this Excel sheet, I've done it for XIC. So let's say in 2001 you started investing and you decided to invest $500 every month, maybe in your tax-free savings account, and you decide to buy XIC from that money. So every month you are investing $500. So when you invest $500, you will be getting some units. Those units, I have based it on the closing price in that month. So at the end of the month, whatever the month closes at, you buy $500 worth of XIC. So if you keep on doing this, you will keep on accumulating like units. So total units you will have, right? Total units will have just a second, I will sign in from a different sheet so that we can view it better. Okay, this is better. So the premise is you're investing $500 every month into this ETF since 2001. So the total units you will have are 6,820. Okay, your total investment value right now will be around 200,000. The ETF is somewhere around $30, so your investment will be somewhere around $200,000. Okay, now if you calculate the rate of appreciation, the rate of appreciation is 4.36% on your capital. So every year your capital is growing by 4.36%, right? Plus 2.82% dividend. So the total returns you are expecting from this ETF in the last 20 years or so is 7.18%, which is a decent return. So your money effectively grows by 7.18% if you invest monthly into this ETF. It has grown in past 20 years. Okay, it might not grow at the same pace, we'll see that, but if you keep on doing that, you will get this much amount of returns. Plus right now, if you see, this provides a 3.1% dividend. So $6,000 will be your yearly dividend, or $500 will be your monthly dividend without even selling the stocks. So you will keep on getting $500 of dividend if you would have done this for the past 20 years. Okay. Now, this is a very interesting chart I have found. So if you see returns between TSX, that is the broad stock market, total return, so appreciation and let's say dividends, if you compare that with real estate, the returns that real estate has given, stocks have outperformed real estate even in Canada. A lot of people think that Canadian real estate is quite good, and it is one of the good asset classes, but if you compare it with stocks in the last 25 years, right, stocks have beaten all the real estate appreciation that you could have received. So what it does, it assumes that you're investing $300,000 in 1996, and over the period of time your money has been growing. So that $300,000 in the last 25 years, like 25 years back, if you put, so in Toronto, if you put in it in a real estate, that will be $1.4 million, Montreal 1.3, Vancouver 1.15, Calgary $1 million. But if you keep it in TSX, if you would have invested in TSX, that will be somewhere around $2 million, which is a bit higher than real estate appreciation in Canada. So along with real estate investment that you have, you should also consider putting some money in the broad stock market. Now, if you even go back further, right, if you go back further to like 50 years, so this is a great chart that shows historical returns of $1,000 invested, right, in different kinds of investments. So if you invested $1,000 and you would have waited, let's say 20 years, that $1,000 would have become $1,300 in T-bills, $1,400 in short-term bonds, $1,800 in Canadian market, like Canadian bonds long-term. TSX, that is XIC ETF that it represents, that would have become $4,000. American stocks, S&P 500, have done better than Canadian stocks in the last 20 years, so that would be $5,000. So $300 extra than the Canadian market. So $4,700 in Canada and $5,000 in S&P 500. So if you compare that with inflation, the value is growing more than the inflation. So this $1,000 should have effectively become $1,472, but stocks have beaten that. You get $4,700 in stocks and $5,000 in American stocks. So if you invested in Canadian stocks and American stocks, your money was growing faster than the inflation in the last 20 years. So if you see last 42 years, right, or even last 50 years, let's compare last 50 years. So if you invested $1,000 in, let's say, Canadian stocks, you would have gotten $100,000 right now, 50 years later. 9.6% average appreciation it has shown in the last 50 years. Canadian, like American stocks, better than that, 11.7% return. So that money, instead of 900,000, would be 248,000. But the important part is inflation. If you see the inflation on it, right, $6,000 will be the equivalent growth you need to beat inflation. So you're handsomely beating it in Canadian stocks or even in American stocks. So, and even if you go back to 72 years, it still holds true. The Canadian stocks are not available for last 72 years because the index wasn't there, but American stocks have handsomely beaten, right, inflation. So the important key takeaway from this chart, if you invest in stocks, you are expected to beat inflation over the long period of time because stocks do keep up with inflation. Even real estate does, but that's a different video, right? So stock is one of the ways you hedge yourself from future inflation. Now, if you see TSX versus S&P expectation, so if you compare TSX, which is the blue line, which is the orange line, and S&P 500, which is the blue line, if you compare total returns, TSX used to outperform S&P 500 in terms of total returns. But last decade or so, like S&P 500 has done better because of tech stocks, heavy reliance on tech stocks, right? So, but it is not expected to hold that way. So Bank of America is striking a bullish tone on prospects of TSX Composite, stating an argument that Toronto's benchmark will outperform S&P 500 over the next decade. So every decade they take turns. A decade, right, when growth stocks are doing well, America has a lot of growth stocks like Apple, Tesla, Microsoft. So they do well when growth stocks are doing well. Canada has a lot of value stocks like 100-year-old companies, utilities, all of that. So if value stocks are doing well, Canada does well. The future expectation is that we are in a high interest rate environment and we are going to remain in a high commodity environment. So if both of these things come true, then TSX does well. That is, the Canadian stock market does better than the American stock market. Okay. So bottom line, the key takeaway from these videos, it is one of the foundational portfolios that you should have, or foundational ETF that you should have in your portfolio. It's a good ETF to do dollar cost averaging. So every month, right, if you want to put some money towards investment, this is a good ETF to do that. You get exposure to the broad Canadian market. It has always, in the long run, it has always historically beaten inflation. Then it has done relatively well against American stocks. American stocks do outperform Canadian stocks, but they are more risky too because they have a lot of growth component, right? But over the next decade or so, Canadian stocks are expected to outperform American counterparts. So this is one of the favorable things about the Canadian TSX. So going back to XIC, it is a broad Canadian market ETF. I personally have around 35% of my portfolio invested into this. I do dollar cost averaging. So every month I do take exposure of XIC just on to build on that dividend. It pays out good dividend double every 17 years. So that's also one of the key things to focus on, and relatively more stable than American ETFs. Plus it is expected to outperform American ETFs. Thank you for listening. See you in the next video.